It wasn't a logistics error, it wasn't a sudden lack of miners, it wasn't even a bureaucratic oversight, it was the mathematical inevitability of a broken price signal. The United States Mint halting production, halting the Morgan dollar, halting the peace dollar, canceling orders, delaying shipments. The official explanation is shortage, the official explanation is supply chain friction. But the arithmetic tells a different story, a story that has played out before in Rome, in Madrid, in Berlin. When the price of the metal exceeds the face value of the currency, the metal goes into hiding, it vanishes from the public view. It leaves the vaults, it leaves the exchanges, it sits in private hands. This is not a conspiracy, this is a mechanical function of bad money driving out good. The pattern is unmistakable. The arithmetic is merciless. Governments do not run out of money, they run out of value, and when the value flees the currency, it seeks sanctuary in the physical silver, is the canary in the coal mine. The shortage is not in the ground, the shortage is at the price point. The government is willing to acknowledge history, shows us the roadmap, it shows us the destination. It shows us the cost. We are watching a recurrence of a very old cycle, a cycle of dilution, a cycle of denial, a cycle of disappearance. The mint's inability to source silver blanks is a symptom, the disease is the currency itself. To understand why the silver is gone, we must look at where it went the last time this happened. We must look at the empires that thought they could print value and found they could only print paper. The incentive is always to expand the supply, the risk is always the loss of trust, and the result is always the same. This is not a matter of opinion or political leaning. It is a matter of historical record and economic law. The phenomenon we are witnessing with the United States Mint struggling to fulfill orders for silver coinage is the modern iteration of a dynamic that destroyed the purchasing power of the Roman denarius, the Spanish real, and the German mark. It is called Gresham's law, but that is simply an academic term for a very human survival instinct. When a government enforces a face value on a currency that is lower than the commodity value of the material it is made of, or when the paper price of a commodity is suppressed below the physical cost to acquire it, the physical commodity withdraws from circulation. It does not disappear from the earth. It disappears from the market, it goes into strong hands, it goes into deep storage. It waits for the currency to collapse or for the price to correct. To understand the gravity of a national mint halting production of its strategic metals, we must look at the precedent set by the Roman Empire, specifically the transition that began under Emperor Nero in 64 AD. Before this date, the Roman economic engine was built on the silver denarius, a coin of high purity that was accepted from the distinct markets of Syria to the garrisons in Britannia. It was the reserve currency of the ancient world, but the imperial costs were unsustainable. The empire had ceased expanding, which meant the influx of plunder had stopped, yet the costs of maintaining the legions and the bureaucracy remained fixed and growing. In 64 AD, following the Great Fire of Rome, Nero faced a reconstruction bill that the treasury could not meet. The incentive was clear. Rather than raising taxes, which would risk political instability and revolt among the wealthy senator class, Nero chose the monetary shortcut. He reduced the silver purity of the denarius from 100% to roughly 90%. He also slightly reduced the weight of the coin to the average citizen. The coin looked the same, it carried the same face of the emperor. It had the same legal tender status, but the arithmetic had changed. By reducing the silver content, Nero could mint more coins with the same amount of raw silver. It was a 10% increase in the money supply overnight created out of thin air. This set a precedent that future emperors would exploit with increasing desperation. By the time of Septimius Severus in the early 3rd century, the silver content had dropped to roughly 50%. The state was essentially counterfeiting its own currency to pay its soldiers. The soldiers, however, were not economically illiterate. They lived on the margins of the empire where purchasing power was life or death. As the silver content plummeted, merchants demanded more coins for the same bushel of wheat or tunic. This is what we call inflation, but in reality it was simply the market discounting the debased currency. The crisis reached its nadir during the 3rd century. The silver content of the Antoninianus, the coin that replaced the denarius, fell to less than 5%. These coins were essentially copper slugs washed in a thin layer of silver to give the appearance of value. Over time, the silver wash would rub off, revealing the base metal underneath. The population responded exactly as incentives dictate. Anyone who possessed an older, Higher purity silver coin hoarded it. They buried it in the garden or melted it down. They refused to spend. They only spent the new debased copper coins. The good silver vanished from the economy completely, leaving only the worthless ghost money in circulation. The mints of Rome were running 24 hours a day, churning out millions of these base metal coins, yet there was a shortage of real money. The empire fractured, trade routes collapsed because no one trusted the currency and the economy reverted to barter. The lesson from Rome is stark. When the state tries to cheat the metal content, the metal leaves the system. Just like the Roman experience of debasement, the Spanish Empire in the 16th and 17th centuries offers a chilling parallel, specifically regarding the mismanagement of massive resource wealth. Spain did not suffer from a lack of silver. Quite the opposite. Following the discovery of the massive silver deposits at Potosi in present-day Bolivia and Zacatecas in Mexico, the Spanish crown controlled the greatest supply of silver the world had ever seen. The Spanish piece of 8 became the first true global currency. One might assume this would guarantee economic stability for centuries. It did not. The Spanish crown, led by Philip II and his successors, fell into the trap of believing that silver itself was wealth rather than a medium of exchange. They used this influx of metal to finance endless religious and territorial wars across Europe, particularly in Flanders. The costs of these wars were astronomical. The crown began to spend the silver before the treasure fleets even arrived in Seville. They borrowed heavily from Genoese and German bankers, pledging the future silver shipments as collateral. The incentive for the crown was to maintain imperial dominance without taxing the Spanish nobility. The result was the price revolution, because Spain exported its silver to pay for war and imported almost all its manufactured goods. The silver flowed out of Spain as fast as it arrived. Inside Spain, the abundance of silver initially caused prices to skyrocket. Inflation estimates range widely, but the cost of living for a Spanish peasant increased, dramatically wiping out the middle class. But the true crisis began when the silver shipments slowed down or were intercepted by privateers. The crown, addicted to the expenditure, could not stop spending. Facing bankruptcy, which the Spanish crown declared multiple times in 1557, 1575, 1596, 1607, 1627, and 1647, the government resorted to minting vellone. This was a currency made of copper with no silver content, yet enforced at the same face value as silver coinage. The population rebelled. Against this, arithmetic merchants would quote two prices, one in silver and a much higher one in vellone. The silver coins, the real wealth, were hoarded or exported to pay foreign debts. The domestic economy of Spain was left with copper tokens that no one wanted. The crown tried to enforce the use of vellone by decree threatening severe punishment for those who distinguished between the two currencies. It didn't matter. The market always finds the truth. The silver disappeared into private vaults and foreign banks, leaving the Spanish citizens with bags of heavy, worthless copper. The empire that owned the mines of Potosi ended up with a currency that no one would accept. Just like the Spanish failure to manage its metal, the Weimar Republic provides the ultimate modern case study of what happens when the link between currency and hard assets is completely severed. In 1914, Germany went off the gold standard to finance World War I. By 1919, saddled with the crushing reparations of the Treaty of Versailles and the loss of its industrial heartland in the Ruhr, the Weimar government faced a deficit that was mathematically impossible to pay through taxation. The chosen shortcut was the printing press. The government began to print the papier mark to buy foreign currency and pay striking workers in the occupied Ruhr. At first, the inflation was manageable, a slow erosion of purchasing power, but by 1923, the velocity of money took over. The pivotal moment came when the population realized that the money in their pocket was losing value by the hour. There was a specific phenomenon during this hyperinflation that mirrors our current concerns with silver. Germany still had silver coinage from the pre-war era, the Goldmark and the silver Reichsmark. As the paper currency began to spiral, these silver coins disappeared from circulation instantly. No one would exchange a silver coin for a wheelbarrow of paper marks unless they were absolutely desperate. The government issued decrees demanding that citizens turn in their gold and silver. Most ignored them. The crack-up boom occurred when the flight from currency turned into a flight into anything tangible. It wasn't just silver and gold people bought pianos, machinery land, and antiques anything. That could not be printed, but the premium on silver and gold was the most visible indicator of the death of the currency. While the official exchange rate might have been one thing, the street price for a silver coin was exponentially higher. The mint could not produce silver coins because the cost of the raw silver exceeded the face value of the coin by a factor of millions. Within hours of minting, the minting process itself became a losing proposition. The metal was too honest for the dishonest system. The pattern repeats in 7 distinct stages. Stage 1 is fiscal dominance. The government's financial commitments, whether they are entitlements, defense spending, or debt service, exceed its ability to collect tax revenue. The political will to cut spending does not exist, and the political will to raise taxes is insufficient. The deficit becomes structural and permanent. Stage 2 is the monetary shortcut to bridge the gap. The Treasury and the central bank coordinate to monetize the debt. In the Roman era, this was clipping coins. In the modern era, this is quantitative easing or yield curve control. The money supply is expanded to absorb the issuance of government debt. Stage 3 is the lag. There is always a delay between the expansion of the money supply and the rise in prices during this period. Policymakers often declare victory, claiming that they have provided liquidity without causing inflation. This is the period of maximum danger, as it creates a false sense of security. Stage 4 is the realization prices begin to rise, usually in essential commodities, first energy, food, and metals. The population begins to notice that their wages are not keeping up with the cost of living. The narrative shifts to transitory factors or supply chain disruptions. Stage 5 is suppression and shortage. This is the stage where the U.S. Mint halting production fits. The government or the exchanges attempt to manage the price of the signal assets, gold, silver, oil, to mask the devaluation of the currency. However, because the paper price is suppressed below the physical demand, the physical inventory drains, shortages appear. Premiums on physical assets skyrocket over the spot price. Stage 6 is the flight. The population loses faith in the currency as a store of value. They treat money like a hot potato, getting rid of it as soon as they receive it in exchange for hard assets. Good money, gold, silver, land, goes into hiding. Bad money, currency, floods the system. Stage 7 is the reset. The currency collapses or is redenominated. A new system is introduced, often pegged to hard assets or a new control mechanism to restore confidence. Just like the historical precedents of Rome, Spain, and Weimar, the current situation with the U.S. Mint is a flashing red warning light in stage 5 of this cycle. The world has not run out of silver. Silver is a commodity that is mined, refined, and traded globally every day. What has happened is that the U.S. Mint, bound by bureaucratic pricing structures and procurement, regulations, cannot source the silver at the price they are willing or legally able to pay. Current data suggest a massive disconnect between the spot price of silver, which is largely determined by paper, The incentive for the mints and the bullion banks is to maintain the illusion of stability. If the price of silver were to explode upwards to reflect true physical demand, it would signal a collapse in confidence in the dollar. Therefore, the paper price remains managed, but the physical metal vanishes. We see this in the draining of the COMEX vaults, where registered silver inventories have plummeted. We see this in the premiums charged by private dealers, which have reached historic highs. The metal is moving from weak hands, public exchanges, to strong hands, private vaults, and strategic reserves. One interpretation often cited by mainstream economists is that these While industrial use is rising the investment demand, the demand for silver as a monetary hedge is accelerating at a pace that mining supply cannot match. The fact that the mint, a sovereign entity, cannot source blanks suggests a deeper structural freeze where sellers are refusing to part with metal at current paper prices. The first potential endgame is controlled decline and revaluation. We saw a version of this in 1934 when the U.S. government revalued gold from $2,067 to $3,500 per ounce. The second endgame is chaotic collapse. If the suppression of the price continues until the physical vaults are completely empty, the market snaps. The paper exchanges declare force majeure, settling contracts in cash rather than metal because the metal is gone.